Hi, everyone, and welcome back to another episode of Heavy Yields. In today's episode, we're going to tackle the topic of inflation, which is a crucial concept to understand for anyone interested in personal finance, investing, or just trying to make sense of the overall economy, and especially a pretty big hot topic right now in Australia and for most of the world. In this episode, we'll discuss what inflation is, what causes it, why high inflation is bad, and we'll also touch on some things called deflation and stagflation. But before I dive in, I just wanted to say a big thank you. We went live yesterday and I publicly announced it to a few people or to my Instagram, my personal Instagram page. And I just wanted to thank everyone for showing Heavy Yields some love and everyone getting around it. So a big thank you to everyone for the support and looking forward to seeing how this goes. Let's dive into some inflation. So, what is inflation? Well, inflation is the rate at which the general level of goods and services in an economy is increasing over time. As inflation rises, the purchasing power of money goes down, meaning you'll need more and more money to buy the same basket of goods and services as you once did. Now, inflation is usually measured as an annual percentage change, with the Consumer Price Index, or CPI, being one of the most common ways to track it. And before I get into the CPI, now some of you may know that the RBA, the Reserve Bank of Australia, which we touched on in the previous video, has an annual inflation target range of between 2 and 3%. And we're currently in an environment that it's quite a fair bit higher than that, but we'll get onto that in a second. Now, the CPI includes a wide range of goods and services that a typical household might consume, categorized into 11 different groups. Now, it's aimed to get a really good sample size of the most common items that a household might purchase in an economy to then measure the increase in price of all of these items. So these 11 groups are food and non-alcoholic beverages, alcohol and tobacco, clothing and footwear, housing, furnishings, household equipment and services, health, transport, communication, recreation and culture, education, and insurance and financial services. So the Australian Bureau of Statistics in Australia, or your other governing body of statistics, wherever you're watching, collects all of this data and then presents the increase in average prices of all of the goods that goes into these baskets on an annual, quarterly, and monthly range. So now that we know what inflation is and how it's calculated, we can have a chat about some of the reasons for a rise in inflation. Now, there are various reasons, more specific reasons for an increase in inflation, but they can typically be organized into three different categories. The first of which being demand pull inflation. Now, this occurs when demand for goods and services increases supply, which causes prices to rise. Now, prices rise in this situation because the consumer is willing to pay more for that good or service, as there isn't enough to go around for everyone. And the suppliers are able to increase their prices because there's a lack of supply and because the consumers have an appetite for those higher prices, which they might not have had before when everyone had easier access to that good or service. The second one is cost push inflation. Now, this happens when the cost of production, such as wages or raw materials, increases, which forces businesses to raise their prices. Now, we're living through a really good example of this at the moment in Australia's, building and housing industry, where the price of timber has pretty significantly increased over the last couple of years due to some supply side or supply chain issues, which has enabled and forced construction companies to raise the prices of their builds as otherwise they'd be running at a loss from the new increased cost of raw materials, timber in this case. And the third is built-in inflation. Now, this happens when businesses and workers expect prices to rise, and then they begin to adjust their behavior accordingly, whether that's businesses rising their prices to get ahead of any price rises that may come in the future. Um, and this can lead to a self-fulfilling cycle of price increases, and inflation gets baked into the economy. Now, it's important to note that a moderate level of inflation is generally considered a pretty good thing for an economy, as it encourages spending and investment. But as we're all pretty well aware, we don't want it to get too high, otherwise it can become very detrimental very quickly. As I just touched on, high inflation can be very detrimental to the economy, and that's for a few different reasons. The first of which is that it reduces our purchasing power. As I touched on at the start of the video, as prices rise, your money buys less, making it harder for all of us to maintain our standard of living. The second is uncertainty. A high inflationary environment can create uncertainty into the economy, which can lead to lower investment and slower economic growth. And as I mentioned in our interest rates video, the Reserve Bank of whatever country you live in this case, Australia, is going to increase interest rates in a high inflationary environment to try and bring that back under control. This creates further uncertainty in the economy, and people typically are going to stop spending their money in the same way they were when things were humming along nicely. The third is it has an income redistribution effect. Now, inflation hurts those on fixed incomes potentially the most, like retirees, as their purchasing power erodes over time and doesn't necessarily catch up as quickly as those of us on wages would. Now, another one is hyperinflation. Now, in extreme cases, inflation can spiral out of control, leading to the complete collapse of a country's currency and economy. This is known as hyperinflation. Hyperinflation is defined as a monthly inflation rate greater than 50%. Now, a prime example of this is the hyperinflation experienced by Zimbabwe in the late 2000s. At its peak, Zimbabwe's inflation rate reached an astounding 89.76 trillion. So that's 8.97 times 10 to the power of 22% year on year in mid-November 2008, with inflation in November 2008 alone being 79.6 billion%. This effectively rendered the currency virtually worthless and caused widespread extreme economic hardship on the country of Zimbabwe. Now, this is quite an extreme example, but it's just a demonstration of the significant impacts of inflation and what can happen if we let it run rampant and don't get it under control quickly. Now that we've explored inflation and hyperinflation, one of the additional terms that I mentioned at the start of the video was this thing called deflation. Now, as I'm sure you might be able to figure out, deflation is actually the opposite of inflation, which means that the general level of prices is falling over time. Now, this may seem like a good thing at first, but deflation can also be harmful in the economy or to the economy, as it can lead to reduced consumer spending, lower investment, and even increased unemployment. When people expect prices to continue to fall, they may delay their purchases, waiting for even lower prices in the future. I mean, I probably would. I'm sure all of you guys would too. So this behavior, known as the deflationary spiral, can cause a decrease in consumer spending, which in turn leads to lower demand for goods and services. As businesses face declining sales and revenues, they may be forced to cut back on production, lay off workers, or even shut up shop entirely. This chain reaction can have a negative impact on economic growth, as it further exacerbates the deflationary cycle. The second term that I mentioned at the start of the video was this thing called stagflation. Stagflation, it's a really unique economic situation where an economy experiences both high inflation and stagnant or declining economic growth, along with high unemployment. It's a really challenging problem for policymakers to combat, as the usual tools for combating high inflation, such as raising interest rates, can further slow down economic growth and even make unemployment worse. It's a pretty sticky situation for an economy to be found in. So we really want to do our best to avoid that. All right, legends. There you have it. A beginner's guide to inflation, what it is, how it's calculated, and also what hyperinflation is. But we also covered deflation and stagflation too. Now, these ideas are crucial to the financial world, and hopefully everyone's got a bit of a better understanding of them after that video. But as always, if you have any questions or want to chat through something in greater detail, please just flick me a DM or, comment on the video, and I'll be sure to answer any and all questions. If you found this video helpful, please be sure to like, subscribe, throw me a follow on Insta, share the video. That'd be a big help for me and for the channel. Now, in the next video, I'll be covering bonds, government bonds and corporate bonds, and how they interact with the market, and also how interest rates and inflation can impact these as well. So stay tuned for that. I'll see you next week. Have a good one, guys.